Welcome back to Investing Talk Podcast.
Today we're looking at TeraWulf.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For the longest time, the investment thesis around TeraWulf was pretty straightforward.
Just a crypto miner, right? Tied to Bitcoin.
Exactly. Their stock price was basically tethered to the volatility of Bitcoin. But what we're seeing now is, well, it's a genuinely successful and I think a critically important strategic transformation.
A transformation into what, exactly?
They're fundamentally pivoting. They're becoming a crucial infrastructure provider in the high-performance computing space.
HPC, you mean?
Right, HPC. Specifically, they're focusing on AI cloud compute hosting. This completely changes the DNA of the company. The whole valuation thesis is different now.
And that pivot is the crucial takeaway here, because it's not just an idea anymore, right? It's showing up in the numbers.
It is. It's translating into concrete financial evidence.
If we look at the recent Q3 2025 results, total revenue was, what, $50.6 million, which is solid.
It is solid, but the strategic nugget, the really important part, is that initial $7.2 million of that revenue. That all came from HPC lease agreements.
Okay, so $7.2 million. It's still a pretty small piece of the pie. Why is that specific number so important?
Because it's disproportionately important. It's the proof of concept. To understand why, you really have to look at the margin difference.
Between mining and HPC hosting.
Exactly. Bitcoin mining it's a high-volume, relatively low-margin business.
Yeah.
It's super susceptible to things like electricity costs and, of course, the price of Bitcoin itself.
Sort of commodity risk.
Right. But AI compute hosting, that operates on multi-year contracts. It offers significantly higher margins. We're talking double or even triple the profitability of pure mining.
And it's predictable recurring revenue.
That's the key. So that $7.2 million, it confirms the infrastructure is ready, that customers are actually signing contracts, and that this journey away from pure commodity reliance is, it's actually happening.
That makes sense. So they're basically trading a really volatile, cyclical revenue stream for something stable and high margin.
A secular growth stream.
But pivoting infrastructure like that requires massive capital and institutional trust. How did they convince the market they could pull this off? The HPC space it's dominated by giants.
That brings us directly to their competitive advantage, which they've built through some really high-level strategic partnerships. This is their moat.
Okay, let's talk about that. The most obvious one is Google, right?
The most obvious and most discussed is the formal partnership with Google. And this wasn't just a basic customer agreement. It involved two very specific components that signal a much deeper commitment.
And we should probably clarify those components because the jargon is specific here. We're talking about a warrant agreement and a recognition agreement.
We are.
So what did those actually mean for the average investor? Let's start with the warrant agreement.
Okay, so the warrant agreement means Google has the right to purchase a certain number of TeraWulf's shares at a predetermined price in the future.
So they have skin in the game.
They have real skin in the game. Google is tying its financial success to the success of TeraWulf. They're not just a customer anymore. They're a financial stakeholder.
They're motivated to see the company succeed.
Intrinsically motivated. Their own investment performance is directly linked to the stock's performance. It's a powerful alignment.
A very powerful alignment. Okay, and what about that second piece, the recognition agreement?
The recognition agreement signals that Google formally acknowledges and supports the specific data center infrastructure that's being built or leased.
So it's like a stamp of approval.
It's quality assurance and financial backing rolled into one. It gives Google direct assurances about the future compute capacity they're going to be relying on.
When a giant like Google acts as both a customer and an investor,
it's institutional validation. It unlocks capital and a long-term demand pipeline that, their smaller pure-play crypto rivals can only dream of. It's a massive de-risking event.
And beyond Google, we also need to look at the Fluidstack deal, right? That's about capacity.
Yes. The capacity commitment there is huge. It's a multi-year deal. And maybe more importantly, they're securing up to a 51% ownership interest in a future 200-megawatt HPC project led by Fluidstack.
Can you put 200 megawatts in perspective for us? What does that actually mean?
It's enough dedicated, high-density power capacity to run a small city. Or, in this context, hundreds of highly demanding AI clusters all running at the same time.
Wow. Okay.
And this all ties back to the operational flexibility we were talking about. Their infrastructure isn't siloed. It supports both markets
So it can switch between Bitcoin mining and the more intensive AI compute loads.
seamlessly.
Yeah.
They do it with modular data center designs and often these really sophisticated liquid cooling systems, which are essential for the next generation of AI chips, like the NVIDIA H100s.
So they can chase the highest margin business at any given time. If Bitcoin volatility spikes, they can pivot to AI for stable revenue.
Exactly. And if AI demand dips for some reason, they still have that floor provided by Bitcoin mining. It's a built-in hedge that mitigates a huge amount of that commodity price risk.
It really does. Okay, so let's move from strategy to the financials. Do the numbers back this all up?
The results suggest the strategy is firing on all cylinders. If you look at Q2 2025 revenue, it was $47.6 million.
And that was a robust 34% year-over-year increase. In this sector, anything over 30% suggests you've really got traction.
It really does.
And we've already established that the strategic pivot is all about higher margins. Did the financials actually bear that out?
They absolutely did. Operational efficiency really shone through, with gross margins hitting 43.8% in Q2.
That's a critical metric. High gross margins mean you can reinvest more, and it gives you a buffer against rising costs.
Right. And when you couple that high growth with this level of profitability, you have the textbook definition of a compelling execution story.
That sets a pretty high bar for future performance. What are analysts projecting now that the market understands this pivot is actually happening?
The projections are aggressive. They're baking in the full ramp-up of these HPC contracts. For 2025, full-year revenue is forecast between $168.9 million and $220.7 million,
So an average annual growth rate of about 41%.
around 41%. But the real attention is on 2026. As those big 200 milliW projects come fully online, projections accelerate. They suggest growth could hit up to 118% year over year.
Whoa, hold on. 118%.
I know.
That sounds like a bubble projection.
Right.
Are analysts basing this on contracts that are already signed, or are they just assuming perfect execution on projects that haven't even broken ground?
That skepticism is definitely warranted. A substantial portion of that accelerated 2026 growth is based on the successful, timely, and cost-effective execution of their current development plans.
Which they've said are targeting 250 to 500 megawatts of new capacity annually.
Right, and that level of rapid expansion requires a constant influx of capital.
Which brings us back to the balance sheet. Do they have the financial strength to support this without constantly diluting shareholders or taking on high-interest debt?
That's where the de-risking strategy really shines. As of Q2, they had a healthy $90 million in cash and Bitcoin reserves, which is a good buffer. But the true strength is that institutional backing. That huge $1.8 billion lease backstop and the equity investment from Google. That fundamentally improves their entire financing profile.
So when they go to the bank for a loan?
Exactly. When they go to secure debt financing, having Google as a committed partner and investor significantly lowers their cost of capital. Borrowing becomes cheaper and easier for them than for their competitors.
That's a clear advantage in a ridiculously CapEx-heavy industry. But back to that execution risk, what are the specific hurdles management themselves are worried about?
Well, running two massive, complicated growth verticals, AI infrastructure and crypto mining, is asking a lot from any operations team.
A whole lot.
And management has been very clear about this in their investor presentations. The primary risk is indeed execution. They have to manage two distinct customer bases, two very different tech environments all at once.
And the timelines for these data centers are tight, I imagine.
Very tight. If there are supply chain delays, unexpected construction costs, or regulatory roadblocks, that whole timeline for 2026 revenue gets pushed back.
Yeah.
And those 118% growth numbers, they fall short.
And beyond the internal issues, they're still operating in a pretty tough macro environment.
Absolutely. Despite the AI hedge, they are still exposed to sector risks. They're highly dependent on reliable low-cost power, so fluctuating energy costs are a threat.
And Bitcoin's price still matters for, what, 85% of their current revenue?
It does. But the infrastructure risks are particularly acute as they scale the HPC platform. Unlike simple mining rigs, AI compute requires continuous, specialized cooling, often liquid-based. That equipment is expensive and complex.
Plus you have cybersecurity, power availability.
Right. They face a constant battle against cybersecurity threats, and ensuring 100% power availability for these AI clusters is way harder than for a simple mining farm.
So high infrastructure costs and the need for flawless operational management. It's a high-stakes game. Let's pivot to the near term. What are the key catalysts investors should be laser focused on over the next 6 months?
The immediate focus is clarity on that HPC revenue ramp. We have two critical earnings releases coming up, Q3, which is scheduled for November 10th, and then Q4 on February 10th, 2026.
And what will people be looking for in those reports?
Two things. Continued sequential growth in that HPC lease revenue and detailed updates on the status and financing of the large new capacity projects.
Okay, and what about institutional movements, things that could cause some short-term volatility?
Definitely keep an eye on the calendar for major rebalancing events. We have the ETF rebalancing on December 15th.
Which could drive a big volume spike if they get added or their weighting increases.
For sure. And then early in the new year, around January 15th, we could see targeted institutional buying. Fund managers focused on HPC and AI infrastructure themes will likely be rotating capital into the sector.
And TeraWulf is one of the few high-growth, pure-play stories available there.
Exactly. It sets the stage for a potentially volatile but high-volume period through the holidays and into the new year.
Shifting to the technical picture, how is the chart digesting all this positive news?
Technically, the stock is showing persistent strength and accumulation. It has consistently traded above both its 50-day and 200-day moving averages since that pivot was confirmed back in late Q2.
So a well-established uptrend. It's not just a speculative pop.
Right. It signals that institutional money is accumulating based on the strategic shift, not just day trading headlines.
What are the key levels traders should be watching?
The primary support area has really solidified around that $10.50 to $11 range. That's where recent pullbacks have consistently found buyers.
And on the upside?
On the resistance side, the immediate ceiling is between $13.50 and $14. A strong catalyst, like a really positive earnings surprise, could easily trigger a breakout above that $14 level.
Okay, finally, let's talk about the noise, the speculative buzz. What unconfirmed rumors are circulating right now?
And we have to be super clear here. This is all just unconfirmed market chatter.
Right, of course. Pure speculation.
But the speculation is centered on three potentially game-changing things. First, the perpetual rumor of a potential acquisition. Given their assets and partnerships, there's buzz about a major tech firm wanting to buy them to expand their own HPC footprint quickly.
That would be the ultimate validation of their whole strategy.
It would be. Second, we're hearing chatter about aggressive new international expansion plans, maybe into Europe or Asia. That would signal a push for global dominance, not just U.S. regional control.
And the third?
The third big rumor is a potential new partnership with another Tier 1 cloud provider for a joint HPC solution, basically following the successful playbook they established with Google.
So when you put it all together, the pivot to high-margin AI, the validation from Google, the de-risking, the growth projections, it really does create a powerful investment case.
It does. The core bullish rationale is accelerating revenue across both businesses, underpinned by those high margins and strong technical momentum. The thesis is kind of dual-edged.
How so?
It offers short-term excitement for active traders looking for that catalyst-driven upside around earnings. But it also offers compelling long-term exposure for investors seeking a pure play on the secular growth themes of AI and digital infrastructure.
And I suppose, given the immense capital needed for 500 megawatts of new capacity every year, the ultimate question for investors is whether TeraWulf can maintain its operational agility as it transforms from a high-growth startup into a utility-scale infrastructure giant. That will be the key test in the year ahead.